The U.S. economy added more jobs than expected during the month of May. The report's telling the opposite story from data out this week that suggested the economy is slowing, which was fueling hopes of a rate cut. To break down what to expect from equities amid a murky macro backdrop, we've got Neel Mukherjee, who is the TIAA Wealth Management Division Chief Investment Officer. Neel, great to see you. Great to have you back in studio with us. Always a pleasure. So first and foremost here, we were speaking about this report earlier, actually, and one of our guests calling it a tale of two surveys here. What's your read in on the data that we got here this morning?
Yeah, well, this is a trend that's been going on for some time now, right? Where the household survey has kept showing that the economy is losing jobs, there's no traction. It measures jobs slightly different than the payroll side of the equation does. Payrolls tends to count your jobs who have people who have multiple jobs, for example. So it potentially overstates the number of jobs. The household does not take into account the immigration aspect of it. The truth of the matter is we're somewhere in the middle, and we'll know that in a few years when everything is reconciled. So a couple of things with respect to this jobs number. A, the economy is not falling off bed. It's still resilient despite the fact that we've had a couple of years of massive interest rate increases. But there is some slowdown in terms of the unemployment rate ticking higher. When I look at the totality of the labor market data, less people are quitting their jobs, so that means less wage pressure. And the number we got earlier in this week, where we saw 8 million job openings, which is down about 18% year over year. Obviously, the peak was 12 million a few years ago, but in totality, I think it paints a picture where the market is cooling, the labor market is softening on the margins, but the economy overall is still pretty resilient.
If you could speak that well from an economist perspective, I am amazed at how much you can speak on the chief investment officer perspective as well here too. Give us the playbook then. If that's the read-in on where the economy sits right now, is there any massive portfolio shift that you envision investors need to at least consider right now?
I don't think so. And if you look at the action in the markets today, again, the story is very much the same. The bond market is still not entirely comfortable and sure that the inflation beast has been slain, which makes sense. The equity market, despite the fact that interest rates are higher, it's trading higher today. It was a surprise on the upside, and it tells you that the Fed may have to keep interest rates a little bit higher for longer than most people were expecting, but the equity markets are higher. The story there is AI and corporate earnings, as you were discussing with your previous guests. So the data is going to become much murkier. The outlook is going to become foggier as we go through the rest of the year. What investors need to do is be very disciplined. They need to be diversified across different asset classes. Most importantly, they need to have their financial plans in place and stick to it.
It's interesting. What type of rewarding do you expect the market to give companies in this environment that once we start to get earnings that roll in for Q2 that either start to beat or miss? Because in Q1, it seemed like they were getting rewarded less and they were getting punished more than historical averages, at least the 5-year historical average based on, I think, some data from FactSet.
It's a really interesting question, and that happens when valuations are extended.
Okay.
Right? The good news has been priced in, so the bar for surprising the market on the upside and getting rewarded for it is that much higher. So we're there. We were there in Q1. Obviously, the markets are at all-time highs. I think what's interesting in the earnings story is a couple of things. First of all, we were in an earnings recession. Now we've had 3 quarters of an earnings recovery. That's because the economy is in decent shape. Inflation is coming down, but it's not crashing, which adds to the pricing power of companies. So that's a good thing. The other is that if we do get to like $240 a share that the market is expecting this year, and as we come to the end of this year, and the market thinks that we can achieve that $270 a share, the market could trade higher. The final thing I'll say on earnings is we're seeing this rotation away from the mega cap earnings to the other companies' earnings accelerating. The mega cap earnings are expected to decelerate as the year goes through. Yeah. Other 493 companies' earnings are expected to accelerate. That will create some volatility, some uncertainty, but if we are in this environment where growth is 1.5%, 2%, inflation is sticky but coming down slowly, and the expectation that the Fed is still inclined to cut interest rates is there, the market can slowly grind higher.
I'll tell you the question that everybody wants an answer to as they're going into their weekend, perhaps going to fire up the grill or go for a swim, is whether or not the S&P 500 is going to continue to see new all-time highs, especially as we have today, or at least on the intraday basis, if we have a higher for longer tenor continue to remain in place after next week's Fed meeting.
I think it can, and it can because of the corporate earnings story, which is good. You need this economy not to overheat. And that's why I come back to those numbers, which is 1.5% to 2% growth, 3% like inflation, but slowly gliding to that 2.5% number. The Fed is still basically dovish, even though next week's meeting they will have to sound a little bit hawkish. They may go from 3 rate cuts indicated to about 2 rate cuts. We'll see what happens. But basically, if they are still inclined to cut rates, and they can do so before the economy really gets into trouble, then I think this equity market can go to new highs. Now, what I will say is, from an asset allocator's perspective, and as you know that we keep our clients invested in our asset allocations which make the most sense for them, equities are going to be in a bit of a consolidation zone, at least till that earnings can play catch up with earnings, with valuations, and the disinflation narrative comes back into the marketplace. That is going to be a necessary condition, those two, for equity markets to move higher. Final thing, fixed income is again looking attractive with yields where they are. So you construct a fixed income portfolio which has govies and corporate bonds, high yields, some riskier aspects of the fixed income market, you can get 5.5% to 6% yields, and they're good diversifiers at these levels, because if you do have a situation where the economy weakens more than expected, the Fed has to cut interest rates, then yields will come down and provide that ballast against the equity risk that I talked about.
All right, haven't heard govies in a while, so we're going to fire up the Yahoo Finance t-shirt maker and throw that on one of those. Neel, great to see you.
Good to see you.
As always, Neel Mukherjee, who is the TIAA Wealth Management Chief Investment Officer, joining us here in studio.